Hello students, we'll continue with illustrations of loss of profit policy. Today we'll be seeing illustration 35. Page number 164 as per new module. We'll just go through the illustration. There are some mistakes. I'll just let you know these mistakes. A fire occurred on 1st July 2013. Actually it should be 2013, but in the book it is printed as 12. So make the correction. A fire occurred on 1st July 2013 in the premises of A Limited, and business was practically disorganized up to 30th November 2013. Again cancel 12 and make it 2013. From the books of account, the following information was extracted. Actual turnover from 1st July 13 to November 13. 1st July 13 is the date of fire. So turnover from 1st July 13 to November 13, 1,20,000. This is turnover during dislocation period. July, August, September, October and November. Turnover from 1st July to 30th November 2012. So here you just write this turnover. You can call this turnover as standard turnover. Right here, standard turnover 4 lakhs. Now what is standard turnover? Standard turnover is previous year's turnover for current year's dislocation. This current year's dislocation period. This is previous year's turnover for current year's dislocation. The standard turnover is 4 lakhs. Net profit for the last financial year is 1,80,000. Insured standing charges for the last financial year is 1,20,000. Turnover for the last financial year is 10 lakhs. Turnover for the year ending 30th June 13 is 11 lakhs. Now what is the date of fire? Date of fire is 1st July 13. So turnover for the year ending 30th June 13 is 12 months turnover immediately preceding the date of fire, which is known as annual turnover. We need this annual turnover while calculating claim if average clause is applicable. So this is your annual turnover, 12 months turnover immediately preceding the date of fire. Total standing charges for the year 1,44,000. Insured standing charges are 1,20,000. Total standing charges are 1,44,000. So 1,44,000 are insured plus uninsured standing charges. The company incurred additional expenses amounting to rupees 18,000, which reduced the loss in turnover. Increased cost of working is 18,000. You are supposed to find out 3 figures out of that least is to be added in loss of profit. We'll see that. There was also a saving during the indemnity period 4972. This is nothing but saving in insured standing charges. The company holds a loss of profit policy for 3,30,000. Now this is actual policy amount. Actual policy amount is 3,30,000, having an indemnity period of 6 months. Indemnity period is 6 months. Actual dislocation period is 5 months: July, August, September, October and November. There has been a considerable increase in trend, and it has been agreed that adjustment of 20% to be made in respect of upward trend in turnover. So there is increasing trend in the business, and what is the increasing trend? 20%. Now this 20% increasing trend is to be added in annual turnover as well as in standard turnover. Just remember this. Compute claim under loss of profit insurance. Now what is your first finding? First finding here is gross profit. How will you find gross profit? Gross profit is equal to net profit plus insured standing charges. Net profit is 1,80,000. Insured standing charges are 1,20,000. Therefore your gross profit will be 1,80,000 plus 1,20,000. Gross profit is 3 lakhs. Next step is to find gross profit ratio. Gross profit ratio is gross profit divided by sales multiplied by 100. 3 lakhs divided by sales. Which sales figure you will take now? This is gross profit for the last financial year. So sales figure is for the last financial year is 10 lakhs. The gross profit ratio 3 lakhs divided by 10 lakhs multiplied by 100, gross profit ratio is 30%. So gross profit we found out, then we found out gross profit ratio. Next you need to find out short sales and loss of profit. Now see here, short sales, standard turnover. This is from 1 7 12 to 30 11 12. Standard turnover is 4 lakhs, which is given in the question. But what is given? There is increasing trend of 20%. So 20% will add in this. So 20% of 4 lakhs is 80,000. So standard turnover is 4 lakhs 80,000. Last year from 1st July to 30th of November, turnover was 4 lakhs. As company is expecting 20% increase, current year it was expected 4 lakh 80,000 as turnover. But because of the calamity, the actual turnover during this period is 1 lakh 20,000. So 4 lakh 80,000 minus 1 lakh 20,000, 3 lakh 60,000 is your short sales. So third finding is short sales. Then you are supposed to find out loss of profit. Loss of profit is nothing but short sales multiplied by gross profit ratio. Gross profit ratio we worked out as 30%. Short sales 3,60,000. So gross profit ratio multiplied by short sales is loss of profit. Loss of profit is 1,08,000. Now in this loss of profit you are supposed to add additional cost of working. For this you need to work out three amounts. First is actual additional cost of working, which is 18,000. Next is gross profit on additional sales at 30%. Now these additional sales are nothing but sales during dislocation period. Sales during dislocation period multiplied by 30%. What are your sales during dislocation period? 1,20,000. Actual sales during dislocation period 1,20,000. 1,20,000 into 30% is 36,000. And third finding is net profit plus insured standing charges divided by net profit plus all standing charges insured plus uninsured multiplied by additional cost of working. Now this is given in your solution, which is not correct, which is wrong. Net profit, what is net profit? 1,80,000 plus insured standing charges 1,20,000 divided by net profit 1,80,000 plus all standing charges 1,44,000 multiplied by increased cost of working, which is 18,000. So if you do this calculation, the amount which you get is 16,667 and not 16,972, which is given in the book. This is not correctly given. Correct figures are this. We'll just go back and see. Net profit plus insured standing charges divided by net profit plus all standing charges, insured plus uninsured. So 1,80,000 plus 1,20,000 divided by 1,80,000 plus 1,44,000 multiplied by 18,000. This is the correct answer, and this answer is not correct. So correct answer is 16,667. You need to add in 1,08,000 minus saving in insured standing charges. This is of course correct. 4,972. You gross claim what you get is 1,19,695. Now you are supposed to check whether the average clause is applicable or not. For checking whether average clause is applicable or not, what are you supposed to check? Compare amount of policy with gross profit on annual adjusted turnover. Now amount of insurance policy is how much? 3,30,000. Gross profit on annual adjusted turnover. Why adjusted turnover? Your annual turnover. What is the amount of annual turnover? Just we'll go back and see annual turnover. Annual turnover is 12 months turnover immediately preceding the date of fire, which is turnover for the year ending 30th June 2013 is 11 lakhs. Now there is 20% increasing trend. So 11 lakhs plus 20% of 11 lakhs. So adjusted annual turnover is 11 lakhs plus 2 lakhs 20,000. 11 lakhs plus 20% of 11 lakhs is 2 lakhs 20,000. 11 lakhs plus 2 lakhs 20,000 is 13 lakhs 20,000 is your annual adjusted turnover, and 30% of that, because gross profit is 30%, 30% of that is 3 lakhs 96,000. So required policy amount is 3 lakh 96,000, actual policy amount is 3 lakh 30,000. So there is under insurance. Actual policy amount is less, so average clause is applicable. So now this 1 lakh 20,000 again will change it. Why? Because we got the figure 1,19,695 after changing this figure. So this is gross claim multiplied by actual policy amount divided by gross profit on annual adjusted turnover. So 1,19,695 into 3,30,000 divided by 3,96,000. So amount of claim to be lodged is not 1 lakh, but it is 99,746. So I want all of you to make this change. Whatever is given in the solution is wrong, replace it with this figures as well as this figure. This will get changed, this will get changed, and the final claim to be lodged with insurance companies is 99,746. Thank you.